Okay, we are cruising through problem 11.1a. We've done the operating section. We've done it two ways, the direct method and the indirect method. Time to move on to investing and financing, and we'll wrap this thing up in this video. So the investing section is all about long-term assets. Did we buy or sell any long-term assets or investments here? And the answer is yes, we didn't have any investments, but we did have equipment. And it looks like we bought and sold equipment. And down here, I can see equipment was purchased for 135 cash. Well, all right, that's cash flow from purchasing equipment. Let's fill that in. Cash paid for equipment, 135. They've kind of given it to us very directly here. Yes, it's 135. I put it in brackets because, of course, that is a negative cash flow, right? You're paying money out to buy equipment. Cash received on the sale of equipment. Equipment sold for cash during the year. This is the next bullet point down. The original cost was 60 and the accumulated depreciation was 45. Okay, so we sold equipment. It doesn't say how much we got for it. It says we had this equipment that cost us 60. The AD, the accumulated depreciation, was 45. So let's figure out what we thought the equipment was worth. The equipment had a net book value of $15,000 when we sold it. Did I get $15,000 for my equipment? The answer is no. How do I know I didn't get $15,000? Well, because we had a loss on sale of equipment of 9. So if I sold equipment that I thought was worth $15,000 and I lost $9,000 on the sale, it means I got $9,000 less than I thought it was worth. I thought it was worth 15. I lost 9. Means I must have gotten just $6,000 when I sold the equipment. So again, the equipment net minus the loss or plus the gain. In this case, we'll go minus the loss equals, I don't know, cash received on sale. Cash received on the sale of equipment of $6,000. So we got $6,000 for selling our equipment. Now, we did not have investments, right? I would be looking under long-term assets, below the inventory, maybe above the equipment or in that ballpark. I didn't have any. So no cash paid, no cash received on sale. 135 negative plus 6 gives us a negative $129,000. This is a cash outflow from investing activities. On to financing, on to our long-term debt section and equity-related section. So here I'm looking at my sort of bottom half of my balance sheet here from the bank loan payable down. These are the areas that are kind of interesting for me. So the first question is, did I issue any new debt? Do I have any new long-term debt? The answer is yeah. I have $20,000 in a bank loan that I didn't have before. In the absence of other information, we have to assume we borrowed cash from the bank. I think that's a pretty safe assumption. So yeah, we had cash received on the issuance of new debt, $20,000. We didn't repay any debt. Now, in some theoretical world, maybe I borrowed $25,000. I paid back $5,000, netting me $20,000 of net borrowing here, and maybe I should have had like minus $5,000 up here and plus $25,000 down there. But we don't know. We're just not told that. So I think it's fair to assume that we just borrowed 20 grand. Now, what about the issuance of shares? Did our shares change? Yes. Our shares went from 50 to 60. It means $10,000 of new shares. And again, in the absence of other information, we have to just assume we issued new shares. It's not like theoretically we could have redeemed 80,000 and issued 90,000 for an overall $10,000 increase in shares, but that's unlikely. Likely we redeemed 0 shares and we issued 10,000. The last one, cash paid for dividends. Let's see, did we have any dividends payable? No, I don't see any dividends anywhere. But I do see this final line. Dividends were declared and paid during the year, so we got a bit of work to do. What I'd like you to do is think about how retained earnings works. And I know it's kind of a pain to kind of flash back to, oops, I've got all sorts of writing here. Here's how retained earnings works. We have retained earnings beginning plus net income. I'm actually going to have a subtotal. Minus dividends equals retained earnings ending. So for any year, retained earnings at the beginning of the year, you add net income, you deduct dividends, you get to your end of year retained earnings. There can be some other adjustments, but in intro accounting class, this is what you're looking at. So let's figure out our dividends then. We know our company's retained earnings beginning because we know our retained earnings ending last year is right here. It was 186, and our retained earnings ending this year is 272. So 186 is our retained earnings beginning. We're going to add net income. How much is our net income? Bottom of the income statement, it's 136. 186 plus 136 is 322. Now, we don't know the amount of our dividend, but what is the amount of our ending retained earnings? Our ending retained earnings is 272. So we got to figure out, okay, how did I go from 322 to 272? I must have had a dividend. How big is my dividend? Well, it's the difference, right? 322 minus 272. Our dividend is $50,000. This company had $50,000 in dividends. Now, there is a formula for cash paid for dividends. Here's the formula. It's dividends declared, which in this case is $50,000, plus decrease in dividends payable. Now, in our company, I don't think we had any dividends payable, did we? No, we did not. I would look under liabilities somewhere, but I'm not seeing it. So in our case, there was no dividend payable, so it's $50,000 plus zero. It's $50,000 is our cash paid for dividends. Let's fill that in. Come on, there we are. Cash paid for dividends, $50,000. This is a negative cash flow. We're paying money out for a dividend. So 20 plus 10 is 30 minus 50 is negative 20,000. And this is a cash outflow from financing activities. Okay, now we're basically done here. We've just got to add things up. Operating, investing, and financing are our three sections. Let's add them together. 164 was our operating. Negative 129 was our investing. Negative 20 was our financing. Overall, our cash should change by $15,000, and it's a positive. 164 minus 129 minus 20 is positive 15. This could be negative very easily. This is a net increase in cash. So my question is, am I right? Did cash increase by $15,000? And is there a way to figure this out? And the answer is, yeah, look at the balance sheet. Did cash go up by $15,000? Let's take a look. Our cash started the year at $24,000. It ended the year at $39,000. The difference is plus $15,000. Yes, we did go up by $15,000. We did get this right. Now, it's not a 100% chance we got the question right. You know, if your prof's marking your exam, they might find some format errors, or you might have made two mistakes that kind of counteracted each other. But this is a very good sign and a very nice moment in an accounting class when you get to the end, you go, oh, it worked. You know, you can pretty much say, oh, it worked. So anyway, cash balance beginning of the year was 24. Cash balance end of the year was 39. And you can just eyeball that and say, yes, that is $15,000 apart. Yes, that worked. And at this point, we've completed our statement of cash flows for bait and tackle. The only other analysis I would do here is if I were looking at this, just eyeballing it, generally when you're sort of an investor, you're interested in a cash flow statement, here are the things you're looking at. Here are what I'm looking at anyway. I'm not a super expert analyst, but this is what I'd look for. Operating cash flows to be a large number and growing. You generally want the day-to-day business to produce positive cash flows, right? Otherwise, the company is burning money, and unless you're a VC in Silicon Valley, you don't like to see this. You want to see positive and growing operating cash flows, generally speaking. Investing, interestingly, you're generally hoping for negative numbers and expecting to see negative numbers here. You know, when a company is growing and just doing good business, they're buying equipment, they're buying assets, right? They're spending money to purchase equipment. So you generally expect to see this to be a negative number. Financing might be positive, might be negative, depends on what they're borrowing, what they're doing. I'm generally, if I'm an investor, looking to see what they're doing in terms of dividend payments. But financing, it's not a specific rule of thumb. But operating, I think it's fair to say you want to see positive and growing. Investing, you're generally expecting to see be negative unless there's something weird happening that year. You know, Facebook ever was forced to sell Instagram, they would have a big positive cash flow from investing that year because it would be worth billions and billions of dollars. But in a normal year, I think Facebook's investing section will be quite negative. And then financing depends if they're borrowing or repaying debt, really, what phase of the business they're in. But I'm not expecting to see either positive or negative. It's going to just be very company dependent. Okay, we've completed the statement of cash flows for bait and tackle. Statement of cash flow is not an easy topic, but I think we're on the right step. If you're feeling like this helped you, please don't be shy about hitting that like button. All right, that's all for this video. Stay tuned for the next one. Bye for now.